Imagine it's January 2026. You turn on the news, and the story seems fine. Economists project 2% growth. The White House insists there was no inflation. But your wallet knows the truth. You feel it at the gas pump, in the grocery aisle. The cost of just living is stubbornly high, and it isn't getting better. While everyone is distracted by politics, a quiet catastrophe is unfolding. For every dollar this country produces, the government now owes $1.24. This debt isn't a future problem anymore. It's a tripwire that's already been crossed. The experts say we can simply grow our way out of this. They're wrong. What they aren't telling you is that the system is now mathematically broken, and the hidden numbers reveal exactly why it can never be fixed. To understand how deep the rabbit hole goes, you have to see when it was first dug. This isn't a story about one bad decision. It's about a series of them, a slow-motion train wreck spanning 4 decades. The blueprint for today's crisis was drawn up in the 1980s. An idea took hold, that major tax cuts could pay for themselves through sheer economic growth. It was a seductive promise. The problem? It never really worked. This was the start of what you could call the Great Uncoupling, the moment when federal spending was permanently uncoupled from federal income. Peacetime deficits, once a rarity, became the new normal. Then came the new century. 2 foreign wars, another round of tax cuts, and new entitlement programs were all put on the national credit card. Both political parties became addicted to spending they didn't have. It was a silent, bipartisan agreement of deficit denial. The numbers just kept climbing, but as long as the economy grew, nobody seemed to mind the bill. The first major shock to the system was the 2008 financial crisis. The government stepped in with massive bailouts, normalizing trillion-dollar interventions. But the real point of no return, the moment the numbers became truly terrifying, was 2013. For the first time, the U.S. debt-to-GDP ratio officially crossed 100%. Think about that. The country's entire debt was now larger than its entire economic output for a year. Both were around $16.7 trillion. A line had been crossed. And then, the pandemic poured gasoline on the fire. Trillions more were printed and spent, pushing the debt-to-GDP ratio to over 124% by 2024. Each crisis was met with more spending, more debt, digging the hole deeper. This wasn't just a series of disconnected events. It was the forging of a financial trap, piece by piece, over 40 years. And what they built wasn't just a spreadsheet problem. It was a cage. Today, we're all living inside it. So why should you care about a number with 12 zeros? Because that debt is a ghost in your bank account. It's the invisible hand reaching into your wallet every time you buy groceries. Officials will point to a headline figure, like the 2.7% inflation rate from last December, and claim victory. But this is what I call the grand deception. It ignores the crushing weight of all the price hikes that came before. It's like celebrating that the floodwaters only rose an inch today, while you're still standing in a submerged house. Every dollar of this debt has to be paid, either through higher taxes or through the silent, brutal tax of inflation. That's your future mortgage payment getting bigger. That's your retirement savings buying less. It's a direct transfer of wealth from your future to the government's present. The system is no longer working for you. It's actively working against your financial security. This wasn't an accident. It was a series of choices. So how did we get here, and who lit the fuse on this ticking time bomb? The machine that broke America wasn't built overnight. You have to go back, not 40 years, but more than a century. Picture New York in 1907. Panic on the streets. The Knickerbocker Bank has just collapsed. There is no safety net. No one to stop the bleeding. Your life savings could vanish in an afternoon. This chaos gave birth to an idea, a powerful one. In 1913, Washington created the Federal Reserve. Its mission was simple: prevent financial fires. To be the adult in the room when banks acted like children. And for a while, it seemed to work. They built a fatal flaw into the system, a back door that would one day be kicked wide open. We call it the banker's handshake. It's the unspoken agreement that the Fed wouldn't just protect the banks. It would protect the government's spending habits too. It became a permanent, reliable buyer for U.S. debt. Need to fund a war? Run a deficit? The Fed was there, checkbook in hand. This wasn't a bug in the system. It became the entire point. The Great Depression still saw more than 5,000 banks fail, but the central power was now entrenched. The government could now write checks its own citizens would never be able to cash. And that handshake, made in the shadow of a long-forgotten crisis, created a silent, automatic process, a hidden engine that drives the debt higher, year after year, regardless of who is in power. It operates completely outside the headlines, and it's the real reason this crisis is now permanent. So how does this machine actually work? What is the secret that allows a country to function while being buried under a mountain of IOUs? It's not broken. In fact, the system is working exactly as it was designed to. It's a perpetual motion machine of debt, and it has a name. We call it the debt carousel. Here's how you get on the ride. Imagine the government needs cash fast, far more than it gets from taxes. It takes its most valuable asset, a promise of your future tax dollars, and goes to a special kind of pawn shop. This pawn shop is the nation's central bank. The government hands over an IOU called a treasury bond. But here's the trick. The pawn shop owner doesn't give the government money from its own savings. It simply prints the money, brand new dollars created out of thin air, in exchange for the government's promise to pay it back. This is the cycle, in 4 simple steps. Step 1. The government spends more than it earns, every single year. This creates a massive budget deficit. Step 2. To fill that hole, the Treasury Department issues bonds, trillions of dollars worth of them. Step 3. There aren't enough real buyers in the world, investors, foreign countries, to absorb this endless supply of debt, so a special buyer is needed. Step 4. The central bank steps in and buys the government's bonds using newly created digital money. The government gets its cash, the spending continues, and the national debt spins one more time around. This isn't an emergency plan. This is the plan. The debt carousel can never stop. If it does, the system freezes, and the financial world as we know it collapses. This is the engine running in the basement of the economy, a machine that turns debt into cash. But how much fuel does it burn? And how close is it to redlining? The official numbers hide the truth, but the hidden numbers, they reveal a mathematical certainty. To see how the system cracks, you have to look at the first time it truly broke. The first time the ghost in the machine showed its face. Picture New York City. The date is October 15th, 1929. The air is electric with wealth and endless optimism. A Yale economist, one of the most respected minds in the country, Irving Fisher, gives a speech. He tells the assembled industry titans that stock prices have reached what he calls a, quote, permanently high plateau. There was no reason to doubt him. The market had only gone up. Fortunes were being minted daily. You could feel the invincibility. 9 days later, the floor fell out. The crash wasn't a single event, it was the first domino. The sound of that fall would echo for a decade. What followed was a financial plague that swept across the nation. It wasn't just numbers on a ticker tape. It was a chain reaction of failure that reached directly into your grandparents' homes. Over the next few years, more than 5,000 banks would fail. Stop and think about that number. Not 5,000 corporations. 5,000 banks. The places where ordinary people, farmers, shopkeepers, factory workers, stored their entire lives, their savings, their hopes for their children, their plans for a modest retirement, all of it, gone. Wiped out in a blink. We can call this the system's first, great erasure. An entire generation's wealth, security, and trust in the American dream simply vanished. The roaring 20s fell silent, replaced by the silence of the breadline. It was the first time the country learned the hard way that the numbers on paper and the reality on the street could be two terrifyingly different things. The system wasn't just flawed, it was fragile, capable of a collapse so total it could erase a lifetime of work overnight. It was a lesson written in financial ruin and human suffering. But this was just the beginning. To understand the crisis, you have to ignore the headlines and look at the plumbing. The hidden mechanics. It's a system so clever and so deliberately confusing that most people never see it working. Imagine your bank account. If you try to spend more money than you have, your card gets declined. The transaction stops. The government, however, has a secret override switch. It starts simply. The government needs to spend money it doesn't have. Billions for infrastructure, defense, social programs. This gap between tax revenue and spending is the deficit. To fill it, the Treasury Department creates a special kind of IOU, a bond. It then sells these bonds at auction. This is where the story you're told usually ends. It sounds responsible. The government is just borrowing money, like anyone else. But who is buying all this debt? Sometimes it's pension funds or foreign countries. But when there aren't enough buyers, a special customer steps in, America's own central bank. And here is the secret. The central bank doesn't buy this debt with existing money. It doesn't pull from some giant savings account. It buys the debt by creating new money, literally inventing digital dollars out of thin air. I call this mechanism the Treasury's echo. The government shouts for money, and the central bank echoes back brand new currency to pay for it. It's a closed loop, a perfect circle of money creation disguised as a loan. A debt is created on one government ledger, and the money to pay for it is created on another. No new wealth, no new product, just more dollars chasing the same amount of goods. Why do most people miss this? Because it's designed to be missed. It's wrapped in jargon like quantitative easing and open market operations. While the media focuses on the political theater of the debt ceiling, this silent machine is running in the background, 24/7. It's the engine that allows the country's debt to grow larger than its entire yearly economic output. For every dollar this country produces, it owes more than $1 back. This isn't a bug in the system, it is the system. A machine for turning debt into cash. And once you see the machine, you can't unsee it. But seeing how it works is only the first step. To grasp why the situation is truly hopeless, you have to look at the numbers. The terrifying, unforgiving math that keeps the machine running faster and faster every single year. The stock market crash was a public execution, a sudden, violent spectacle. But the truly fatal blow wasn't delivered with an axe. It came years later, a slow-acting poison administered in the quiet halls of power. This wasn't a panic, it was a policy. Think of it as the sovereign ceiling, an invisible line in the sky where a nation's total debt eclipses its entire yearly economic output. For centuries, crossing that line was a death sentence. It signaled a nation on the brink of collapse. But for the United States, it became a new beginning. The moment the country officially owed more than it produced in a year, the machine didn't shut down, it went into overdrive. This was the cascade. Not a sudden crash of falling stock prices, but a slow, relentless waterfall of new debt, washing over every corner of the economy. The lessons of the past weren't just ignored, they were inverted. The solution to a debt crisis was more debt, an order of magnitude more. The problem was no longer contained to Wall Street, it had metastasized. This new crisis wasn't about a single industry. It was about everything. It funded wars without tax hikes. It financed bailouts for companies deemed too big to fail. It propped up a lifestyle the country could no longer afford on its own. The scale was no longer a few city blocks in Manhattan. It was the entire national economy, from the Rust Belt to the Sun Belt, all floating on a sea of IOUs. This created a bizarre paradox. The system designed to prevent collapse now required a permanent state of emergency to function. The cascade wasn't an accident. It was the new operating system. A quiet crisis that never makes the front page, but grinds away at the value of every dollar you earn, every single year. And here's where it gets personal. The official numbers are designed to be boring. Percentage points, basis points. They are a sedative, meant to keep you calm. But let's ignore the commentary and just do the math. The math is not calm. The interest payment on the national debt is the monster hiding in the budget. It's now over $1 trillion a year. That's not a payment on the debt. That is just the fee to rent the money for 12 more months. A service charge on our own national bankruptcy. Break that down. It's over $80 billion a month, $3 billion a day, or $120 million an hour every single hour. Now, look at the engine meant to pay for this. The economy. Projections show the U.S. economy might grow by 2%, maybe 3% on a good year. Let's be generous and say it hits 3%. That generates roughly $840 billion in new national wealth. Here is the hidden calculation, the one that guarantees failure. The interest payment is over $1 trillion. The new wealth created is under $900 billion. This is what I call the growth deficit. It's a structural certainty. Every single dollar of new economic growth, every new job, every new company, every innovation is consumed by interest payments before it even exists. And we still come up short by hundreds of billions. This gap is a black hole at the center of the economy, and it's growing. This isn't an accounting error. It's a mathematical trap. The only way out is to take more from you in taxes, or devalue everything you own by printing more currency. The system is no longer running to prosper. It's running on a treadmill, just to service the past. So what happens when the math becomes undeniable? When a country can't even afford the interest on its own credit card? The numbers point to only a few possible and terrifying scenarios. Now, you might be thinking this is just doomsday talk, that the skeptics are always wrong. The most common objection you'll hear is what I call the growth cure. The argument is simple. A growing economy will solve the debt problem. If your income grows faster than your mortgage, you're fine, right? The same applies to a country. Optimists will point to projections of new growth fueled by technologies like AI. They'll highlight a month like December 2025, when inflation came in below the forecast of 3.1%, as proof the system can correct itself. It's a comforting thought. And to be fair, a technological boom could certainly help. We can't entirely dismiss the idea of an economic miracle. But this argument misses the terrifying velocity of the problem. It's like noticing your garden is growing while your house is on fire. The debt is no longer a static number, it's an accelerating force. The interest payments alone are consuming a colossal slice of the national budget, crowding out everything else. To outgrow this, the United States wouldn't just need a good year. It would need a sustained economic explosion, unlike anything seen in modern history. You would need to win the lottery every single year just to make the minimum payment on a credit card that's already maxed out. The growth cure ignores the math. The patient is bleeding out faster than the medicine can work. Every new dollar of economic growth is already claimed by the interest on yesterday's promises. It's a treadmill to nowhere, and the speed is constantly increasing. But even if they were right, so what does the endgame look like? The path forward splits into two distinct futures. Let's call the first one Scenario A, the managed decay. This is the story officials want you to believe. The economy avoids a crash, but it never truly soars. Growth putters along, just enough to keep the lights on. You feel it as stubbornly high living costs. You see it in a softer labor market. Each year, your purchasing power quietly shrinks, a slow, grinding decline disguised as stability. The system doesn't break, it just rusts in place. This is the high-probability outcome everyone is banking on, a future of quiet stagnation where America's problems are always tomorrow's problems. But then there is Scenario B, the unraveling. This is the stress test. It begins not with a bang, but with a loss of faith. Imagine a sudden escalation of tensions in the South China Sea, or a new global crisis that spooks the market. Suddenly, the foreign nations that buy America's debt pause. The demand for U.S. bonds dries up. To attract new buyers, interest rates would have to explode overnight, not by a little, but by a lot. The interest payments on the national debt would instantly become the single largest item in the federal budget, eclipsing defense, Social Security, everything. The machine grinds to a halt. The probability of this is low, but it is not zero, and it grows every day. Now, the obvious objection is that this has never happened, that the U.S. dollar is the world's reserve currency, and America can simply never run out of money. But there's always one last argument, the final defense. It's the ace up Washington's sleeve, an idea so powerful it has silenced critics for decades. I call it the dollar shield. The argument goes like this. America can't truly go broke because it owns the global printing press, the U.S. Dollar is the planet's reserve currency. It's the language of international trade. This unique position allows the U.S. to run a debt that has climbed to 124.30% of its entire economy, a number that would trigger a death spiral in any other nation. Need to pay interest? Just create more dollars. It's the ultimate financial superpower, a seemingly infinite line of credit backed by the entire world. It seems unbreakable. But that shield isn't forged from steel. It's woven from something far more fragile, trust. And that trust is fraying. While some economists talk about a coiled spring economy, leaders in other nations are quietly building escape hatches. They see the endless deficits. They watch the rising tensions in places like the South China Sea. And they are making a calculated choice to diversify away from the dollar. This isn't a dramatic overnight rebellion. It's a slow, methodical chipping away at the foundation. Each bilateral trade deal that bypasses the dollar is one thread pulled from the shield. Each central bank buying gold instead of treasury bonds is another. So while the shield still stands, it's growing thinner every year. This isn't just an abstract theory for policy wonks. It's about the foundation of your own financial security. And from where I'm standing, that foundation is showing cracks that can no longer be ignored. So what am I doing with my own money? Let me be perfectly clear. This is the point where I must issue a disclaimer. I am not a financial advisor, and nothing I say here constitutes financial advice. This is simply a journal of my own navigation through these treacherous waters. Think of it as one person's plan to secure a lifeboat. My strategy is what I call the 90-10 split. It's a framework for extreme uncertainty. 90% of my liquid capital is my fortress, held in hard assets completely outside the traditional banking system. The other 10%? That's my scout. It's a tactical position, nimble enough to maneuver through the chaos. The position sizing is deliberate. I can afford to lose the scout, but the fortress must survive. My triggers for action are specific. I'm not watching cable news, I'm watching the unemployment rate. The moment that number settles above 4.2%, the game changes for me. I'm also watching for the first signs of an AI investment bubble popping. That kind of speculative mania is a classic late-cycle indicator. But right now, that scout position is not in hiding. It's positioned for a short-term upswing. Because the most deceptive part of any systemic crisis is the final, euphoric rally. The last party on the Titanic, where the band plays louder to drown out the sound of cracking steel. And all the data suggests that party is about to begin. The official story will always sound reassuring. They will promise 2% growth. They will celebrate when the unemployment rate settles around 4.2%. But these are the vital signs of a patient in managed decline, a sedative for the public. The core truth is this. The system isn't broken. It's a transfer mechanism. Your savings, your labor, your family's future, they are the collateral in a game you were never meant to win. This isn't a political debate. It is a mathematical certainty, and the final bill is coming due. To protect what you've built, you must first see the hidden exits. Our next investigation exposes the specific assets designed to survive the coming reset. Follow this channel to see that report. The Great Reckoning is no longer a forecast. It is a countdown.